So this problem that we're looking at is E16B-31. So it gets a little bit more complicated here. And it says the income statement and additional data of Energy Plus Inc. follows. So we take a look at that. We see the income statement. Take a look over here. See some of this additional information, which we will need a lot of this to get this problem done. And it says prepare the spreadsheet for the 2015 statement of cash flows. Format cash flows from operating activities by the indirect method. Use the transaction references in panel B when selecting the transaction references in panel A. Only complete the necessary boxes, leave all others blank. Do not check your answer until both panel A and panel B have been completed. So panel A is right here. So we've got various options for debit versus credit, and then balance over here. And then we can look down here and see our statement of cash flows and these various letters by areas where we will enter numbers. And when we enter those numbers and the various categories here, these are the letters that we will use when we enter those same numbers up here to get us from beginning balance of the balance sheet at the end of September 2014 to the balance sheet at the end of September 2015. Okay, so for instance, if I look at the balance here for cash, I see that the end of 2014 it was 28,000. The end of 2015 is going to be 37,000. I know that that is going to be a debit of 9,000, or at least that's one way, assuming that I only have one entry of getting from cash of this amount to cash of this amount, and theoretically there's going to be some transaction down here on panel B that is what got me from here to here, and so whichever transaction that is, A, B, C, D, E, F, G, 1, G2, H, I, J, K, L, or L, rather. That's what I would plug in there once I had all of these figured out. So, let's jump into this a little bit here. Let me erase that. And a good place to start would be by looking at some of this information. Okay, so I think the best way to handle this, and we see all this information here, and these numbers here are going to help us to answer some of these questions. But I think it's best to kind of go down the line here, look at the various sections, and try to fill out this statement of cash flows, and that will be what leads us to be able to fill out the panel A section. So first of all, under the cash flows from operating activities by the indirect method means we're going to start with net income, assuming that it's a net income versus a net loss. Okay, so to be able to tell what that is and whether it's income or loss, I'm just going to take a look at the income statement here. And I see that net income for the year is $46,000. So obviously that's a gain. So I choose net income over here instead of net loss, and $46,000. Okay. So down here on the statement of cash flows, anything on the debit side is going to mean that it increased cash for the business entity. Okay. So not that it increased someone's cash. So paying cash dividends, obviously that increases the cash in the investor's pockets, but it decreases the cash that the entity paying the dividends has. So, keep that in mind as we fill this stuff out. So for this section, cash flows from operating activities, I'm going to put in $46,000 of net income on the debit side for cash. So now under the indirect method, in order to get down to net cash provided by operating activities, what I'm basically doing is I'm looking at net income, that's what I start with, and then I'm going to add back in or subtract out transactions that affected net income positively or negatively, but that didn't actually affect cash flow. So if I look under this first one here, I've got a choice of either depreciation expense, plant assets, or loss on sale of assets. So depreciation expense, plant assets, I'm going to look over here and see if there was any depreciation expense. I need to pull up, there we go. So I need to pull up the income statement, and I can see here under the operating expenses, one of the items that affected the net income was this depreciation expense. Well, since depreciation expense is just an accounting entry and is not actually a transaction that takes place, this $25,000 that was subtracted out to get to net income needs to be added back in if I'm only concerned with the cash flow coming from operating activities. So I will select depreciation expense, plant assets, $25,000 to show right there that that's what happened, and then I'll move on to the next one. So if I just look at the next drop-down box here, it's giving me a choice between either decrease in accounts receivable or increase in accounts receivable. So depending on which one I have, if I have a decrease in accounts receivable from 2014 to 2015, that basically means that I have received cash that has not necessarily been captured by the revenue I recorded for the year. Okay, so this may indeed be revenue that I recorded from a past year, but I'm receiving cash from it now because someone was paying off their accounts receivable. So if I look over here at this information, I see that accounts receivable from 2014 to 2015 decreased by $14,000. Okay, so that means to have a decrease, someone paid cash, and the offsetting entry when I received a debit of cash was to accounts receivable. So that had no effect on my revenue for the year, and that revenue number is what if you see here under the income statement, I have sales revenue. So I don't, in getting to net income, I have nothing on the income statement is affected when an accounts receivable is paid. But cash, and that cash was from our operating activities, did increase during this period when someone paid off their accounts receivable. Okay, so again, I'm going to show decrease in accounts receivable, and I need to add back in $14,000 because that is cash that came from operating activities that was not captured on the income statement. Okay, now, so for my next section, I look at my drop-down menu and I've got a choice between decrease or increase in merchandise inventory. So let's look over here at merchandise inventory. We see that between 2014 and 2015, inventory increased by $4,000. Okay, and if we look up here, this is supposed to be the relevant data. So again, what we're concerned with is whether this increase in merchandise inventory affected cash. Okay, if this inventory was all purchased with a note payable or some type of liability, then this wouldn't affect cash and it wouldn't go under this section. But we have no information here that suggests that this inventory purchase was made with any type of loan. So that tells us that this was made with cash. And when a transaction occurs where we're purchasing inventory, there is no expense recorded. We see the debt or the journal entry that would record a purchase of this inventory would be a credit to cash and a debit to inventory. Okay, so that would be lowering of one asset account and increasing of another asset account. So the fact that it doesn't show up as an expense means that it would not show up on the income statement, which is where we got our net income to start with. That means that this is, again, some other transaction that affected cash from operating activities that didn't show up on the income statement. And that's what this whole reconciliation over here is about. It's about adding back in or subtracting out any cash that was not included in this figure of net income. Okay, so the fact that we have added $4,000 of inventory suggests that we paid $4,000 in cash to get that inventory, and that $4,000 is going to be a credit to cash because our cash goes down by purchasing that inventory. So our next drop-down menu here, we see either an increase or a decrease in accounts payable. So we look at our comparative balance sheets, 2014, 21,000, 2015, 31,000. So we're going to have an increase in accounts payable of $10,000. So now what that means is when we recorded whatever transaction occurred to make this accounts payable go up, we basically recognized a $10,000 expense. So the transaction would have been a debit to whatever expense it was we were paying with accounts payable. So let's just say this kind of is irrelevant, but let's say like let's say rent expense. Okay, just throwing something out there. So let's say rent expense was $10,000. That would be a debit to rent expense for $10,000 and a credit to accounts payable for $10,000. That would cause accounts payable to go up by $10,000, and it would also cause an expense to show up on our income statement in the amount of $10,000. Okay, so that would show up here. We don't have a rent expense here, but that was just a made-up category, just to show what we're talking about here. It could have also been the salaries expense, but $10,000 would go into this expense, and why that's relevant is because that would show net income as $10,000 less. Okay, but the fact of the matter is, when we made that transaction, cash was unaffected. So what we want to do is we want to add that $10,000 back into our statement of cash flows to show that even though net income was reduced by $10,000, the cash was not used to pay that expense, and so we want to add that back into the net income so that we can get to our eventual net cash provided by operating activities. So our final portion here of the reconciliation between net income and net cash provided by operating activities is a choice between decrease in accrued liabilities and an increase in accrued liabilities. Well, we just take a look over here at our comparative balance sheet again, 2014 versus 2015. So we see a decrease of $5,000. Okay, so if liabilities decreased by $5,000, the only way that that happens generally is if we pay them off. Okay, so we have these liabilities. When we accrued the liability, that's when we recognized the expense. So that's when it hit the income statement. When we paid it off, it had no effect on the income statement. So we have a payment of cash that did not go in to the calculation of $46,000 of net income. Okay, so since accrued liabilities decreased, we want to put that there, and since we paid out cash that's not reflected in this $46,000 number, we need to show a debit to cash for this reduction of liabilities, and that is where that goes. Okay, so that gets us down to our net cash provided by operating activities, which it's not asking us here to fill in, to do the math here to fill that out, but that's where that would go right there. Now we're going to take a look at the cash flows from investing activities. So our first choice over here is a choice between either did we receive cash or did we pay cash with respect to plant assets. Well, if we take a look over here at, well, first we could take a look down here and see, okay, plant assets went up by a good deal from 2014 to 2015, went up by $118,000. Now we need to look up here and see if that was a cash transaction. If we look at additional data section A here, we see okay, here's the $118,000 change in plant assets. Of that amount, $103,000 is paid in cash. So we're concerned with that cash payment because that affects cash flows from investing activities. So if I click down here, we see here, yes, I made an acquisition of plant assets, and yes, I used cash for some of that. How much cash did I use? Well, it says right there I used $103,000 of cash. So that's a credit in this statement of cash flows because it decreased the amount of cash that I have on hand. So my next choice here is what happened with land. Well, again, we could look up here, comparative balance sheet, land from 2014, land from 2015. We see that land was reduced by $24,000, okay, worth of land. And if we look up here, we see that we received $24,000 in cash for sale of land with no gain or loss. So that means it was basically sold for book value. So we can see how was cash, what happened? Well, we received payment for sale of land. How was cash affected? It was increased by $24,000. Okay, so then that would bring us down if we were filling out this next line, which it doesn't have us do in this problem, but you see here it says net cash used for investing activities because the cash flows from investing activities were negative. So since you had a net loss of cash there, that's why it says net cash used for investing activities. So next step, we go down to cash flows from financing activities. Now our first choice here is cash payment of notes payable or cash receipt from issuance of notes payable. So we can take a look over here and see how overall notes payable was affected for this period. But we have to be careful here too, because we see from 2014 to 2015, there was an increase of $1,000 in notes payable, okay? But then we want to come up here and take a look at the nature of what happened with notes payable for this period. So here we had, remember, we had this acquisition of plant assets, part paid by cash, part paid by a note payable, okay? What's important to recognize here is this $15,000 in notes payable definitely affects how the year-to-year difference in note payable plays out. But what you'll also notice here is this $15,000 has no effect on cash because you're signing this note payable in exchange for some other types of assets, our plant assets, okay? So for the purposes of our cash flows from financing activities, this $15,000 note payable is irrelevant. However, if we scroll further down here into the transactions that occur, we see a payment of note payable in the amount of $14,000. So we were gonna, this one definitely affects cash because we paid theoretically with cash, and so our cash is affected with a credit of that amount, $14,000, because we paid cash for this note payable, okay? And again, the payment of that cash in the note payable is not recorded in this net income. Well, now that's kind of irrelevant because we're out of operating activities anyway. But this is a cash payment that occurred during this period, and so we need to record it in our cash flows from financing activities. So our next section, did we purchase treasury stock or did we issue common stock? And again, purchase of treasury stock would just mean that there was outstanding common stock that we're buying back. So both of these are talking about how was common stock affected. Well, we see here, if we look from 2014 to 2015, the amount of common stock went from $9,000 to $38,000. And we look up here and see that we issued common stock for $29,000. That accounts for the difference between these two. If we issue $29,000 of common stock, what are we getting for that? We're getting cash. So we're going to show a cash receipt from common stock of $29,000. Let's go down here to the next one. cash payment or receipt of dividends. Well, we take a look over here. What dividends do we have? We have a payment of dividends in the amount of $13,000. Does that affect cash? Yes, it does, because we're paying cash dividends. So cash is going to go down for our entity, the business, for $13,000. Of course, the investors who are receiving that dividend are getting cash, so this is one to be careful of. Remember whose perspective you're looking at, or through whose perspective you're looking when you're doing this statement of cash flows. It's not the investor's perspective, it's the business entity's perspective. Okay, so now we're going to calculate overall, was there a net increase or a net decrease in cash? And I don't love how this is labeled here, but this is basically looking at all of these sections here. So overall, in the statement of cash flows, was there a net increase or a net decrease in cash? So there's a couple of ways that we can figure this out. The way I'm going to use is, again, I'm just going to pull up my little calculator here, and I'm just going to look at each column, and I'm going to total it up and put it down here in this bottom number here. Now, it's important to remember that I'm not going to leave both of these totals in here. I just want to get my totals written down. Another way you could do this is pull up a spreadsheet, total them up in the spreadsheet. But let's look at the credit side first. So I've got 4,000 plus 5,000 plus 103,000 plus 14,000 plus 13,000 equals 139,000. Okay, so I'm going to put 139,000 right here. Again, this is not my final answer. This is just kind of a placekeeper for me. And then I'll do the debit side. We'll start with 46,000, add 25,000, add 14,000, add 10,000, add 24,000, and add 29,000. Okay, so I have 148,000 here. And then I'm just going to compare these two. How does 148 compare to 139? Well, obviously it's bigger, and the amount that it's bigger is $9,000. So my overall change is going to be a net increase in cash of $9,000. Okay, so if I did this, obviously this would probably be better to do in an Excel spreadsheet, just so that you have these numbers in front of you. But for now, I just use these as a placekeeper. And now that I know that this debit side was $9,000 more than this credit side, I will zero both of those out, and I will just put $9,000 here. Okay, so now it's important to look at that number, $9,000, come up here or look at this comparative balance sheet and make sure that the difference between 2014's cash and 2015's cash agrees with what I put on my statement of cash flows as the either net increase or decrease in cash. I put a net increase of $9,000, and if I look here from 2014, so I should add $9,000 to that and get to this number, and in fact, that's what happens. So that's a good thing, definitely. Now I'm going to look down here at the non-cash investing and financing activities. And if you recall, up here we had, well, just look at this here. Did we have, if we're looking at non-cash activities, it's definitely going to have to be a non-cash item that we're putting in here. Well, this right here says cash receipt from something. Obviously, that's not a non-cash item. Do we have an acquisition of plant assets by issuing a note payable? Yes, we did. How much was that for? We had a $15,000 note payable there. So that's going to go in here. Total non-cash investing and financing activities. Just adding that number back in there again, 15,000. And now I should, and we have the total numbers down here. which well, I guess I could add those up right now. So I'm basically, well, I guess I could pull this calculator up. I'm just going to add down this total again. So, oops. Start with 4,000 plus 5,000 plus 103,000 plus 14,000 plus 13,000 plus 15,000 equals 154,000. Now look at this side, and I've got 46,000 plus 25,000 plus 14,000 plus 10,000 plus 24,000 plus 29,000. I'm not going to add in, of course, this right here because that's just representative of the overall net effect of all of these numbers, so that would kind of be adding double if I added that back in. So my last transaction here is just going to be 15,000, and I'm left with 163,000. Okay, so that's the end of this panel B section, and now I want to go through here and fill in from information from panel B to fill out panel A up here. Okay, so I'm filling out up here. I think it's easiest or best to just kind of start here and work our way down. So we got $46,000 of net income. Well, what does net income usually affect on the balance sheet? Well, that will affect your retained earnings from one year to the next. So we started with $264,000, and we're going to add $46,000 of net income to our retained earnings. Now you'll see right when we do that $264,000 plus $46,000 does not equal $297,000. So we know right away that there's going to be a credit side to this transaction as well. So we can look down here and see which other entries we have that would affect retained earnings. And so if you look down here at cash flows from financing activities, you can see that we paid $13,000 in dividends. Well, where did those $13,000 in dividend payments come from? They come from retained earnings. So we'll take that $13,000, that was transaction K down here, and we'll add that back in. And if you net those two out, it comes to $33,000 increase, and that is the exact increase between last year's retained earnings and this year's retained earnings. So we balance there, and that's a good thing. So going down the line here, transaction B is depreciation expense of $25,000. Where does that show up? If we look up here, if you remember journal entries for depreciation expense, they basically are netted against accumulated depreciation. So any depreciation expense you have will increase the accumulated depreciation from one year to the next. You'll see here accumulated depreciation carries a credit balance, and so accumulated depreciation increased from $24,000 to $49,000 during the year. And how do you make that increase? That shows up as a credit of $25,000, and we see here this depreciation expense is what gets us from that one to the other. So that's going to be transaction B. And one thing to keep in mind here is you see here this transaction is a $25,000 debit down here. That's because in this particular instance, what we used this transaction to do was add back in to the net income because no cash was used to make this transaction happen. What that doesn't mean is that it has to be a debit up here. when we're plugging in numbers up here into the comparative balance sheet to get us from one number to the other, we need to keep in mind basically what kind of balance does this account carry. It carries a credit balance because it's basically a contra asset account. But you can see just by the numbers here, it's a negative number, so that's a credit balance. And so how do you get from one negative number or one credit balance to an increase in that credit balance? Well, you're going to increase with a credit here, so $25,000. Okay. Our next transaction is part C down here. That's a $14,000 decrease in accounts receivable. And if we look up here at the comparative balance sheets, we see a $14,000 decrease in accounts receivable. How do you decrease a debit balance? Well, you credit that account for the amount. So we'll show a credit of $14,000 here, and that is the decrease in accounts receivable, so that's section C. Now section D, we had a $4,000 increase in merchandise inventory. We look up here, yes, it went from 89 to 93. That's an asset account. It carries a debit balance. How do we increase a debit balance? Well, we debit that account for the amount in question. So this is transaction D, increase of $4,000, so that's a debit of $4,000 there. Look at transaction E. We had an increase in accounts payable for $10,000. So let's look up here at accounts payable. We see that in fact it went from $21,000 to $31,000. So again, how do you record an increase in an account that carries a credit balance? You do that by crediting that same account. Okay. So I know it's a little bit confusing because up here under the asset side, when something carried a credit balance, it was negative. That's just because that is on the asset side. Okay. So anything that carries a credit balance on the liability side or owner's equity side will just show up as a positive number. Okay, so I don't want to confuse you there. But again, looking down here, that $10,000 increase in accounts payable was transaction E, so we'll plug it in there. Then we had a decrease in accrued liabilities, which is transaction F. So again, let's plug that in right here. We went from $25,000 to $20,000. This is a liability account. It carries a credit balance. How do we decrease a credit balance? We do that by debiting the account. So that's a $5,000 debit. And that was transaction F. We already recorded that. Now we come down here, we see transaction G1 for $103,000. And that was a cash payment for acquisition of plant assets. So let's come up here to plant assets. We see here under plant assets that they gave us two lines of space to work with here. And that's because our acquisition of plant assets consisted of a cash amount and a notes payable amount. So the first one that we came to was the cash payment for $103,000. That was G1. It was $103,000. This is an asset account. So to increase the asset account by $103,000, we want to debit it right here. And then we might as well look down here to see what we need to plug in here to finish out this transaction, even if it's not the next one on the list. So if we go down here, we can see that we have this acquisition of plant assets by issuing a note payable. That's number G2. So we'll plug in G2 right there. Again, we're increasing an asset account here, so that's going to need to be a debit to show that increase. So look down here at number H. We have cash receipt for sale of land. And how does that show up on the balance sheet here? Under the land account, we see that the land account, which is an asset, decreased by $24,000. How do you decrease a debit balance account, which all asset accounts are? You are going to credit the account for that amount. Okay, so that was $24,000 credit to that account, and that is transaction H here that did that. And just to be clear here, I know that all of these transactions that affect cash would have effects on the cash here, but for purposes of the comparative balance sheet and the fact that they only give us one line here to work with cash, we're going to go down here and just use the net effect on cash as our transaction that affects cash. Otherwise, each one of these transactions that affected cash, there would have to be a line for each one of those. So this would be a lot longer. But what we're actually going to do here is just use the net increase or decrease in cash to show what happens in the cash account. Okay, so with that being said, that was number H, or part H that we just did. Now we have a cash payment of notes payable, $14,000. So let's look at notes payable. And we see here, again, that the net effect for notes payable was it increased by $1,000. Okay, so we know that since this carries a credit balance, this side, we know there's going to be two transactions here, and this side overall is going to need to be $1,000 larger than what happens on this side. Okay, so the transaction that occurred here was we paid off a note payable. So notes payable should decrease by $14,000. How do we decrease a credit account? And I believe that was number I. Let me double check here. Yeah, number I. We debit this side for $14,000. But if we left it at that, we would go from $14,000 to 0 over here. Since this year's balance is $15,000, we know that we're going to need to have $15,000 on this side. Okay, and if we come down here, we can see that where that $15,000 comes from is from this G2 amount down here. And actually this G2 here, $15,000, since these are both the same number, it doesn't really matter which one you use, but actually this part here is what's going to affect right here. So let's just change that to G2. Okay, so that brings us down to finished number J. Let's take a look at, well, let me make sure that I put that in there right. Okay, 14 to actually, they have this labeled as part J and the other one is part I. So let me just change that to part J. Okay, now I need to look at this part I, the cash receipt from issuance of common stock. So if I look up here, common stock balance increased by $29,000. It's a owner's equity account, so carries a credit balance. So we have $29,000 here, and that was part I. Okay, and then the only thing that I haven't touched yet is this net increase in cash, which is part L. So if I come up here, cash was increased by $9,000. Whoops. Okay. And then basically all I need to do down here is use my calculator again and add 9,000 plus 4,000 plus 103,000 plus 15,000 plus 5,000 plus 14,000 plus 46,000. And that gets me to 196,000. Whoops. Let me highlight down here. Total of 196,000. I want to look at this side, the credit side. 14,000 plus 25,000 plus 24,000 plus 10,000 plus 15,000 plus 29,000 plus 13,000 gives me to 130,000. Okay, so I want to check the difference between these two. So I have 196,000 minus 130,000 equals 66,000. Okay. If I take a look at this one, I've got 333 plus 66. Whoops. Whoops. Did that. Okay. Well, actually, what I should be doing here is 333, 123 plus 196, 123 minus 130, 123. Okay, so I'm off a little bit here, so I need to see where I made my mistake. And the way that I'm going to do that is just go through and analyze each one of these transactions and see if what I entered here really takes me from this number to this number. Okay, so from 28,000 to 37,000, I need a debit of 9,000. I have that. From 59,000 to 45,000, I need a credit of 14,000, which I have. From 89,000 to 93,000, I need a debit of 4,000, which I have. From 90,000 to 208,000, I need a debit of 118,000. If I add those two together, that's what I have. From 24,000 to 49,000, as a negative number here, a contra asset basically here and here. I need a credit of 25,000. And from 91,000 to 67,000, I need a credit of 24,000. So all of these look right so far. So now let me look down here. 21 to 31 requires a credit of 10. 25 to 20 requires a debit of 5. 14 to 15 requires, let's see, those should be credit balances. So to increase by $1,000, I need the credit side to be $1,000 greater, which it is. From 9 to 38, 29 is correct. From 264 to 297, I have, or I require, a net of 33, which I do have. Okay, so, I see one big problem here is that these two should be flip-flopped. So from getting to 264 to 297, since this is a credit balance of retained earnings, this should actually be the bigger number, the 46,000 should be on this side. And 13,000 should be on this side. And then, okay, the other problem here, so this is just proof that your professor can make mistakes too, and should make you feel better about any mistakes that you've made on this problem. But if you look closely here, you can see that this column down here is only supposed to reflect total liabilities and stockholders' equity. And if you followed me through my additions and subtractions, I was adding the debit side of everything here, including the assets, when in fact what I should have been adding was just from the beginning of the liabilities and stockholders' equity section down, and same with this column over here. So let's erase this part. Let's erase this part. And let's try this little math problem again. We start with 5,000 plus 14,000 plus 13,000 equals 32,000. And then we have 10,000 plus 15,000 plus 29,000 plus 46,000 equals 100,000. So if we start with 333,000, which is right here, we add 32,000 to that. Well, that's a credit balance. So we really want to add 100,000 to that, because if we added 100,000 credit, that would be making this number go up. So we'll add 100,000 to that. We'll subtract 32,000 for the debit side, and that gives us with our ending balance of 401,000. So again, make sure that you remember everything basically on this side of the basic accounting equation, the liabilities known as equity, always carries a credit balance, which means that to increase the numbers on the account, you need credits versus debits. And so when you're balancing, you want to take original balance, add the credits, subtract the debits, and that should be your final balance. So let's see. Does it look like I've completed everything on this question? It does to me. So let's go ahead and check answer. Okay. So it says one or both of my totals in panel A is incorrect. Let's see, what did I add wrong here? So I'm not really sure what they're asking for here. I have to assume maybe they just want to show that the debits and the credits balance. So we're going to try it again by just adding top to bottom instead of, to me, it would suggest if you're asking for a total down here, they would match up with the line that you're talking about, and so that it should be totals that get you from this number to this number. But I'm going to go ahead and try adding all the way down my debits and credits and see if that's what the software is looking for. Of course, it'll give us the answer if I don't answer it right this time anyway. And I'm fairly certain that all of these numbers here are correct. So it's just a matter of understanding what it is they're asking for at the bottom number here. And again, this is one of the negatives of My Accounting Lab software. But I think the positives outweigh the negatives. So, and this is one of the reasons why it's just a completion grade. Whoops. So our total there was 163,000. So theoretically, our credit side balance should also equal that, but I'll go ahead and do the math anyway. 14,000, 25,000, 24,000, 10,000, 15,000, 29,000, 36,000, and we're at 163. So let's see if that is copacetic. Wow. Okay. Well, it said the net change in cash was incorrect, but I think we can pretty much all agree that getting from $28,000 to $37,000 requires $9,000. And down here, that's what we have listed. So let me just click on this final check and see what it would change for us. Apparently I'm going to blow up my accounting lab here. But like I said, it's somewhat glitchy software. You got to take the good with the bad. But the good news is, when you're having trouble like this, you can get with me, ask me, and I can, use a real brain instead of a computer brain. Obviously, the computer can only do what it has programmed into it. So it's trying to tell me that this would be a $9,000 here. And then it would be in that column instead of the column that it's in. Yeah, it says I answered nothing. Okay, so I answered 9,000 here instead of 9,000 here. I would say the overall net increase in cash, since we're recording the increases in cash on the debit side and the decreases on the credit side, that should in fact be on this side. But again, like I said, it's glitchy software. Bottom line is we know that the cash increased by $9,000. Whether they think it should be on the credit side when you're writing that down here or not, we take that $9,000, plug it in as a debit to cash up here of $9,000, and all of these numbers work out correctly. So again, this is actually good that it happened this way because it illustrates the glitchiness of the software and the fact that even though we know that this is a net increase in cash, just the fact that it's entered on this side versus this side can cause you to miss the question. Of course, in real life, if I were to hand grade your assignments, I would not mark off for that. Just as long as you know what the concept was, that it took $9,000 debit in cash to get from this balance to this balance, you are in pretty good shape. I think they basically have it show up down here as $9,000 on this side because adding $9,000 to this side is what would allow you to balance the debits with the credits down here. But if you actually wanted to show overall what the effect on cash was, you would show a $9,000 increase in cash, which would be recorded as a debit. So if they were to label this a little bit more efficiently, I think you would have less trouble seeing that as the answer. The other thing you can look at, which I probably should have done just to comply with what the computer wanted, is you can see here that they put the letter of the transaction on the side of the debit or credit side where they want the answer to go. So I should have just looked at this and said, okay, they have the L on this side. I'm going to plug it in here, but to me, increase in cash is always going to be a debit transaction, so that's why I put it there. Anyway, this is a pretty long question. I recognize that all of the questions are fairly long. I didn't look and work through this homework before I assigned it, so for the future chapters I'll work through it first, and obviously if it takes me longer than an hour to explain the homework to you as I walk through it, obviously it takes a little bit more time to talk through it as I go, but if it takes me longer than an hour to get through the homework while I'm explaining it to you and videoing it, then I think that's a little bit excessive because as you're beginners in accounting and just learning this stuff, I don't want to overwhelm you with work. So had I worked through these problems ahead of time, before I assigned this section, I would probably have just cut it here and let you just do these first two questions as homework. But I will work through the last two just so you can see what you're missing, and I'll make changes in the future.